Welcome to our High Rock monthly video for February. I'm Scott Tomlinson, and with me on the call is Paul Tepsich, who is our founder and the portfolio manager. Okay, let's be quick today. I think we can do this hopefully a little quickly. January was a good month for all asset classes. The risk asset classes, the higher risk asset classes, certainly were significantly better. The lesser risk assets were up, and all in, balanced portfolios rebounded very nicely from a pretty difficult 2022. Paul, I don't know if you have anything that you want to add in here specifically, but for all portfolios, it was generally a good start to the new year.
Yeah, well, we should knock on wood, having said that, because just looking at this chart, and these are just some prices, but there wouldn't be much in the way of dividend or income on top of that. But seeing equity markets around the world up 6.5 to 7.5% in 1 month is a pretty good year, in fact. So I would temper some of our enthusiasm with regards to certainly equity risk. For sure.
And I totally agree. I think there was maybe a little bit of a bounce back, and we'll talk a little bit more about what we see coming with interest rates and inflation and stuff like that just a little into the program here. But our ETF that we monitor as part of a series of benchmarks, but the one we sort of watch was almost up 5% for the course of the month. So that's pretty decent bounce back. If you recall, for the year, this same ETF was down about 11% in 2022. So making back like almost half of what it lost in 2022. So that's a good bounce back. But as you said, Paul, I think we all have to temper our views going forward. We're in all likelihood heading towards some significantly slower economic growth, and that will work its way into the financial markets at some point, which we think will likely favor the bond side of the equation as opposed to the equity side of the equation.
Yeah, I agree with that for sure.
Okay, but continuing from 2022, our high yield mandate was still doing well for the first month of January, so that offers some positives for that specific situation. Paul, I don't know if you have anything to add or throw in there.
Yeah, it was just pretty much, I would say, a standard month. We have a couple positions in there in the high yield mandates that are still pretty able to provide some optionality to the upside. So looking forward to those continuing to come to fruition. But in general, again, pretty much everything was up.
Yeah, and just to be clear, for our balanced portfolios and those who hold some of the tactical model, some of those positions are also in the tactical model, correct?
Absolutely. Talk about those in a bit.
Yeah, okay. Just to continue on. Of course, we monitor short-term events because we have to. We look for opportunities that get created in the short term, but our focus is always on your long-term plan. And I'll talk a little bit more about that as we get into talking about more about client service and our updates for that for 2023. So let's move on to talk a little bit about the economic situation. The focus to a large degree has been and still is on inflation. Inflation driving central banks and their interest rate forecasts and what they're doing to try to slow inflation. As Paul has mentioned on a couple of occasions in these calls in the past, we saw inflation peak midway through last year. It's on its descent, but it still has a ways to go. Paul does think, and I'll let you expand on this, Paul, that it may accelerate to the downside as we head into the mid part of 2023. Certainly, and we'll talk about this as well, because when the Bank of Canada raised its rate on January 25th, it was fairly clear that it would likely be taking a pause unless there is some significant change to its outlook for inflation coming down. And I think, Paul, again, you'll probably agree that you think inflation is going to come down faster than many. And so we don't expect to see anything happening with the Bank of Canada. The Federal Reserve raised rates by a quarter on February the 1st this week. And the next meeting for the Federal Reserve being March the 22nd, after today's employment report from the United States, there is now a fairly significant probability of another 0.25% increase in March. And then beyond that, it's about a 50-50 situation as to whether there be any more increases going forward. But the next meeting for the Federal Reserve would be in May. So at least one more increase, and the potential for another, especially after today's employment data. But that could all change rather quickly. And Paul, you can, if you wish, you can elaborate a little bit on your thoughts.
Yeah, I'll be pretty quick, Scott, and I've written some blogs on this, and certainly the last one, I think when Canadian inflation came out, one of the things that I'm looking at is the more recent ticks in inflation, which have been on a month-over-month basis, surprisingly low. And if you look at, say, the last 3 months of inflation, both in Canada and the US, on a month-over-month basis, if those trends continue, then we're going to have a much lower inflation than certainly the central banks are talking about. And I think than the market is predicting, even the bond market, to be honest. So we'll see. There's no guarantees that that occurs. There could be upticks in inflation, but the bet we've made since October is that inflation peaked, interest rates have peaked, and we've added selectively to our interest rate exposure in various securities across the portfolio. So we'll keep an eye on it.
Yes, excellent. Thank you for that input. Global equity strategy going forward, not a lot to say. We are, for the most part, for our longer term clients, pretty close to being fully invested. There's still a little bit of tweaking here and there in the global equity strategy. On a pullback, we may want to add what we think might be the potentially best rebounding equity asset class in technology in the NASDAQ, but we're still looking for opportunities to perhaps put some money there. But at this stage, if you've been with us for a while, you're probably pretty invested in the global equity model. Because last year in the downturn, we did take advantage of opportunities as they came along, and that's where we're at this juncture. So as equity markets go up, that positively impacts everybody's portfolio who has a balanced model with us. Paul?
Tactical update. We had a continued move higher in one of our positions, which is still arguably a distressed bond. We consider it equity, that being Source Energy. They are a solid 75 cent on the dollar bid for 2 million out there, and offered at 80. So as most of our older existing clients that own this bond and were able to participate over the past year and a half or so, I think our average cost, Scott, is around 35, 36 cents on the dollar. And this thing yields, still today, it yields 25%. I think at the time we bought it, we were over 35%. So it's been, actually, we don't own a lot of it. It's a very measured position, but it has more than doubled for us, which is great. And I think there's still, at a bare minimum, good coupon or interest income to come out of this bond, if not some capital appreciation to the upside.
Excellent.
Away from that, like I guess I should add that our share at stock position added a bit of value across the month, probably moved up from 50 odd cents to low 60s. I still think that is the biggest potential for capital appreciation in our overall portfolios, but most certainly in the tactical model. Away from that, maybe we'll move on to fixed income. The change there, one notable change was our Roger investment grade corporate bond, Rogers Communication. They paid us our final, just a couple weeks ago, our final consent fee. So it was 1.8 points. And a total, we were paid 5.5 points on that bond. One was last fall, and the other one just paid 2 weeks ago. And kind of complicated, but that was on the something they had to do with regards to a timeline on their acquisition of Shaw Communications, which looks like it's likely to go through, but that won't affect our position. We've been paid our consent fee, and we still like owning that bond post the consent fee payment. So that position actually worked out pretty well for us, and that's something we bought last spring.
And when you say we got paid the consent fee, that means that gets distributed out to all our clients who own the Rogers bond, right?
Yeah, so each position, it basically was deposited into each client's account. Every client that owns that bond, that consent fee payment of 5.5 total points was paid into their account as by way of cash, which I could just, we won't dwell on this, but the consent fee on all the bonds that were issued, these special mandatory redemption bonds that Rogers issued to acquire Shaw, the court proceedings, because the Competition Bureau put up a big stink, it cost, just in consent fee, it costs about $835 million for Rogers to pay out those consent fees to us across a few different bonds, but certainly one of the ones was the one we owned. So 885 million. In the end, it looks like they won the court proceeding and should be able to acquire Shaw as long as the federal government approves so at the minister level. Anyway, fixed income.
Yeah, that's a neat story, and
it's stunning. It's absolutely stunning that unelected officials could sway that much power in the system. And that doesn't include, legal fees and court fees and advisor fees. It's absolutely stunning. Anyway, that to our benefit, we had a good call on that one. Also in fixed income, just moving along, Scott, is we continue to swap out of our preferred share rate resets, which are more variable rates, and into fixed rate. And again, they are somewhat illiquid and difficult. We're about 50% of the way through, so it's been helpful. The fixed rate bonds that we have bought over the last few months have actually improved quite a bit and had a very good move. But of course, that makes them more difficult to buy because we don't own enough or a model weight yet. So we're about 50% of the way through that. And the last thing I would just add is the FX, the Canadian dollar improved by about 1%, and given most existing clients have about a 20% weight in US securities or cash, so that detracted from our performance by about 0.2% or so. And that's it.
Excellent. Thank you for that. Some administrative stuff. Everybody should have received their fourth quarter year-end 2022 report. If you did not get it, please get in touch with us because we want to make sure that you're getting that. Everybody gets emailed these reports. We found in the past, sometimes they end up in people's spam or junk mail. So just because there are attachments, sometimes this happens. And if you didn't get it, we want you to let us know so we can get it to you. One of the things that is important about these reports is that if you haven't had a review, and I've had a number of reviews, but there's still a number of you out there who have shied away from a review. So we do want to have these, and it's very important to us. We want to make sure that when appropriate, we're updating your wealth forecast, and that if necessary, we are making adjustments to your asset allocation strategy, because as is our focus is making sure that we get you to your long-term objectives, and that's important. Now, we also need to talk to you about making TFSA contributions, RSP contributions. I've had lots of conversations with clients so far, but I need to have these reviews in order to determine what the best strategy going forward for you is along these lines. So please, please make sure that you try to get back to us if you can. We also are, because we have most of our clients have been with us for quite some time. The IDs that we have on file have expired, and we need to get updates for the regulators for those. So that's another important reason that we need to be in touch and just have a regular review. As well, it is coming on tax time, and often we get last minute issues and questions. One of our clients has the ability to access all of their tax receipts online, so you don't need to wait for them to be mailed to you. You need to have a client access to the Raymond James website. If you don't have that, we're happy to set it up for you. Everybody usually is set up when they join, but sometimes people forget their usernames and passwords. So let's if you need to get in touch with us for this, then we will do that. It is easier than waiting for all these individual paper by mail receipts. So get in touch, because we're happy to assist along these lines. Finally, one thing to make note of, because a lot of people like to get their taxes done as soon as they possibly can, so it's not hanging over them. The one unfortunate thing is that trust income, the T3 that we receive, comes directly from the companies who we own that create trust income, and they're not they have until March 31st to send those out, but it's not something that Raymond James sends out. These come from the individual companies. So we do want to make sure that you don't file before you receive these, because then you'll be needing to refile, and nobody wants to be doing that. So again, March 31st is their deadline. So best not to file before March 31st until you've received your T3s. And that's basically all I have to say. If anybody needs to get in touch with us, here are our contacts. You know where to find us. We are always available and want to hear from you. So please do so. And we're always happy to set up time to meet and have conversations. But that's all I have to say on behalf of Paul and Diane. Wishing you all a nice February. It's awfully cold out there right now. Let's hope it goes by real quick, and we get into the potentially nicer weather in March. So that's when we'll see you or talk to you next at the beginning of March. So until then, take care.